First off, first learning objective deals with the balance sheet. The balance sheet is a one-day snapshot. That's a key concept. Typically done at the end of the month, listing what the firm owns and what the firm owes. On the left, what it owns, on the right, what it owes, and any residual leftovers. Typically done at the end of the month. So in January, we do it on the 31st. In February, we do it on the 28th or 29th. In March, we do it on the 31st. In April, we do it on the 30th, and so on through the year. So again, that poem you learned in kindergarten pays off. 30 days have September, April, June, and November. All the rest have 31, so on and so forth. That's when we do our balance sheet. The last day of the month, it's the one-day snapshot of what you own on the left, assets, and what you owe on the right, plus any residual in the form of shareholders' equity. The balance sheet equation is assets equal liabilities plus owner's equity. Again, listed in order of decreasing liquidity in all cases. Cash is listed first. It's the most liquid. Cash and marketable securities. They can be turned into cash fairly quickly. Accounts receivable is listed second. Inventory listed third. And on down through the balance sheet, it gets less and less liquid. Down at the bottom, you're seeing property, plant, and equipment, which would be difficult to turn into cash quickly, and other things, other assets like intellectual property, trademarks, patents, and copyrights, things like that, very difficult to turn into cash. So they ordered in order of decreasing liquidity. Same thing with the liabilities. My accounting teacher in graduate school used to scream and bang on the desk, "It's gotta be." And I'm looking at him mystically. What do you mean, it's gotta be? It's gotta be. He kept saying, it's gotta be. It's gotta be what? It's gotta be balanced. Assets must equal liabilities plus owner's equity, or you can't go home for the day. So the accountants will stay in the office till the balance sheet is balanced. It's gotta be balanced. Here's an example of a balanced balance sheet for U.S. corporation. You see that the assets equal the liabilities plus owner's equity. What we own is on the left, what we owe is on the right, plus any residuals like shareholders' equity. Whenever I look at a balance sheet, I want to look at how liquid is this company. And you can get a feel for that by looking at the assets because they're listed in order of decreasing liquidity. How quickly can they be turned into cash without any loss of value? That's what liquidity means. Current assets, assets with a life of less than 1 year. And fixed assets are longer-term assets with relatively long lives. Like I said before, intangibles, patents, trademarks, intellectual property, copyrights are usually classified and listed as other assets. Assets minus liabilities equals shareholders' equity. Liabilities are also listed on the right side of the balance sheet in order of decreasing liquidity, classified as current liabilities or long-term liabilities. Current liabilities are things like accounts payable, notes payable, wages payable, interest payable, taxes payable, wages payable. Long-term liabilities have a relatively fixed life or long life. Bonds payable, mortgages payable. Mortgages can be 15, 20, 30-year type instruments. Bonds, same thing. Typical corporate bond runs 30 years. So liabilities are listed in order of decreasing liquidity. The ones that have to be paid first are the current liabilities. Longer-term liabilities can be paid at a later date or over time. Shareholders' equity, like I said, is residual value. It's what's left over after I take all my assets, possibly sell them, pay off all my liabilities. What will be left over is known as shareholders' equity. Now, this one has about 5 or 6 different names. You may see shareholders' equity marked down as owner's equity, stockholders' equity, book value, net book value, or net worth. You need to know that all 5 of those items mean shareholders' equity. Same thing, assets minus liabilities. So how do I calculate net worth? Assets minus liabilities. How do I calculate net book value? Assets minus liabilities. How do I calculate shareholders' equity, stockholders' equity? assets minus liabilities. The order of the shareholders or stockholders' equity account is dictated by tradition, typically common stock first, paid in capital, paid in surplus, capital in excess of par, preferred stock is in there sometimes with some companies, and then finally retained earnings where your net income is collected and aggregated each and every year. It's a growing account. It's an account, cumulative account is a good way to put it, my retained earnings account. Every year, whatever net income I have, I throw into the retained earnings account under shareholders' equity. Again, if I were to sell all my assets off, pay all my liabilities, what remains is known as shareholders' equity. Another important concept on the balance sheet is net working capital. This one we must never forget. We want to have more current assets than we do current liabilities. What we own on the left, what we owe on the right. In this case, current assets are several times current liabilities in a very comfortable position to be in. And I can figure out the net working capital by just taking the current assets, 1464, minus the current liabilities, 389, and calculate your net working capital, and you always want that to be positive. When I look at a balance sheet, I want to look at three things: liquidity, how liquid is the company, how much debt do they have versus equity, and what is their market value versus their book value. Have they increased their book value when they started the company to today's market value, or has it decreased, in which case the company would be in trouble? Liquidity. If you look at a balance sheet, let's say Apple Inc., and you see gold listed on the balance sheet, ask yourself, is that liquid? If you see some companies aggregating cryptocurrency, so if you go into the Tesla balance sheet and you see that Elon Musk has bought some Bitcoin, is that liquid? Can you change that into cash very quickly? And the answer is yes, very, very quickly on various and sundry exchanges like Coinbase. You can turn your Bitcoin directly into fiat currency very, very quickly. So speed and ease, where an asset can be converted to cash without loss of value, that is called liquidity. Is Tesla liquid? Is Apple liquid? Recently, we looked up Apple's cash and marketable securities, and it was in excess of $200 billion on the day we looked it up. So I'd say they're pretty liquid. Debt versus equity. With all that cash, does Apple need any debt? Do they have any financial leverage? That is leverage, fancy word for debt, D-E-B-T. How much debt is in a firm's capital structure? That's the amount of financial leverage they're employing. And do you need to have debt if you have $200+ billion in cash and marketable securities? You have to answer that question yourself. Apple has indeed recently taken on some debt. Interest rates were very low, so they took advantage of issuing some Apple bonds. Too much leverage can put you into financial distress, so be careful to not put too much into debt. And it begs the question for Chapter 3, what is a good, quote-unquote, debt-to-equity ratio? Where am I safe? And we'll give you several opinions on that in Chapter 3. And when I look at a balance sheet, I want to look at market versus book. What is the true worth of the company today? Market value, which is just the number of shares outstanding times the market price for the day, versus the historic cost or book value. What is the historic cost? What is the book value of the company? And obviously the job of the financial manager and all the officers is to increase market value per share of existing stock. Here's a good example, a real-world example of market versus book. Here's a very, very popular game, Madden 2020, 2022. He pushes this out every year. And you could see at the time it cost $59.99. Now it was, on the day we looked it up, it was selling for $9.99. So here's a case where book was way higher than market. Original historic cost was way higher than market. Hopefully market eventually, sometimes this passes with time as that game becomes rarer. You may see that thing selling on eBay or Amazon for $89.99 or $99.99. So surpassing the book value. So these things change. There is no relationship between book and market value. One is not always higher than the other.